Now here's a concept that if you're an FRS Special Risk employee approaching retirement, I bet you've heard. The idea is if you're married, you choose option 1 for your pension. Now that's the option where if you die before your spouse, then your spouse gets no continuation of benefits. They get nothing. But option 1 also has the highest monthly payout. So to make up for that, you also go out and you buy a large life insurance policy. That would then be paid to your spouse when you die, and then your spouse goes and takes that money and buys an annuity or invests the money and draws an income from it to make up for that pension that they lost. Sounds like a great idea, right? Not so fast. Let's think about it for a minute. I'm Allen Giese, and our firm, Northstar Financial Planners in Plantation, helps Special Risk FRS employees make better decisions with their finances. So with this pension maximization idea, the FRS employee is obviously trying to increase his or her pension payout. The trick is to get the cost of the life insurance policy to be less than the difference between the payout at option 1 or option 3 or 4. So let's say a life insurance agent you're talking to shows you a plan where the cost of the policy is less than the difference between the two pension payouts. Now you have to ask yourself, is it really enough life insurance to replace my pension? I mean, how do you know how much you need? Have you factored in inflation and a reasonable return for the money? And a conservative assumption for your spouse's life expectancy? What if he or she lives to be 100? The problem is, I often see plans like this where the retiree has far too little life insurance in place to really accomplish their goal properly. Now that of course makes the premium lower, which makes the idea appear to work until it doesn't. But at that point it's too late. And here's typically the culprit more often than not. You have to understand that the life insurance agent gets a commission for selling that policy, right? And that commission is no small amount. It can be as high as 100% or even more of that first year's premium for the policy. So the agent has this huge incentive to get that insurance in place. And so often I've found that in fact his or her number 1 concern is to get that policy in place. And their number 2 concern is it enough insurance? We believe you should always have somebody else besides the life insurance agent who stands to make a big commission and therefore has a conflict of interest figure out how much life insurance you really need in this situation. Somebody that you can trust. Now I'm going to point out something that may or may not be obvious. Let me ask you, how does the state determine the difference between the option 1 payout and the option 3 payout, where the option 1 payments end at the retiree's death and the option 3 payments end at the second of the 2 married persons' deaths? They determine the difference using mortality tables. Well, guess what? They use the same mortality assumptions that life insurance companies use, except there's one big difference. Insurance companies are for-profit businesses, and they're going to include a markup to make that profit. The state doesn't do that. The truth is, the average age a healthy 50-year-old lives to doesn't change because he or she has a life insurance policy versus FRS pension option 3. So in essence, option 3 has already factored in mortality at most likely a more favorable rate than the insurance company. So if the insurance is coming in at a better rate, then logic dictates that something's amiss. Again, it would probably make sense to have somebody who doesn't have a vested interest in you buying that life insurance policy take a look at it and give you their unbiased opinion. Remember, once you make this decision to retire, there's no going back and changing it. Okay, now one other problem I have with this option 1 and then buying life insurance idea. Now this is a little bit more philosophical than mathematical, but hear me out. Why do most people pick the pension plan monthly benefit over the investment plan? I mean, why do they do that? Well, everybody I've asked says it's because they feel like they're the type of personality that feels more safe and secure not having to invest that money, and they're afraid of making a big mistake. They like the security of knowing that every month they're getting a check, no matter what. So let's say an FRS retiree and his or her spouse does take option 1 and buys a couple $1 million of life insurance. What happens when the retiree dies? Well, of course, the check stops coming from FRS, but the spouse gets a check from the insurance company for a couple $1 million. Now what are they supposed to do with it? Think about it. They're distraught. Is this a good time to be making major financial decisions? Is this a good time to be shopping for an advisor that they can trust? Is this a good time really to be looking at annuities from life insurance agents? Are they really going to take any investment risk with that money, even though you probably built the assumption that they are when you determine the life insurance amount? Aren't they basically just a huge target for every unscrupulous commissioned salesperson with the greatest investment you've ever seen in their briefcase? And isn't having all of that investment risk exactly what you're originally trying to avoid, which is why you took the pension in the first place? Logically, in almost every case, we think it's just a bad idea. All that security the FRS retiree had when they were getting a monthly check, it's gone. And probably at one of the worst possible times as far as the surviving spouse is concerned. Believe me, because I've been there as an advisor, surviving spouses aren't looking for risk. And losing the security of their income that they live off of, that's a big deal. I have a few other issues as well, but those are the biggest ones. My point is, there's a lot to think about and a fair amount of homework that you need to make sure is right if you're considering taking option one and buying life insurance to replace the lost income to your spouse. Every case is unique, but it would be a good idea to bounce the idea off of someone who doesn't have a vested interest in you buying the life insurance and has the ability to correctly analyze the situation. So if you find yourself in that or any other complex situation, or you just want to know if you're making smart decisions in today's economy, consider Northstar Financial Planners for that second opinion. We think you'll be glad you did. So thanks for watching, and be sure to stay safe out there. Now, if you're an FRS employee and would like to have a free copy of retired Battalion Chief Gary Gonzalez's book explaining everything that you need to know about retiring from FRS, just give us a call or drop us a line.